Why do most business ideas fail even before they actually start? Because they don't properly evaluate the feasibility of their business. Hello everyone, welcome to the financial modeling class. In this session, we are exploring one of the most practical areas, and that is the feasibility model. Now, first of all, let's understand the main objective of this model. Why do we actually prepare a feasibility model, and what's the real purpose behind it? Here's the thing, whenever you start a new business or even plan a new project, you must first check whether that business idea is actually viable or not, and whether its profitability can meet the expectations of the investors. Before starting any business, it's very important to prepare a complete and detailed feasibility model, because this model helps us forecast the numbers and prepare all three key financial statements: the income statement, the balance sheet, and the cash flow statement. To understand whether a business is truly viable, we also need to consider the investors' expectations, which we generally call the cost of capital. Look at this. If the business is feasible, then its return on capital must be greater than the cost of capital. And that's exactly the main criteria that defines whether a business is financially sound or not. Once that evaluation is done, a decision can be taken by the entrepreneur or by the investors to either accept the project or reject it based on the results. To make this decision, we calculate the net present value along with the future cash flows and then use those results to make proper financial judgments. So in a feasibility model, it becomes very important to understand how to prepare projections, how to forecast the numbers, especially when the business has not yet started and we don't have any past data to rely on. Now think about it. At this initial stage, we don't have any historical figures to refer to. So where do we actually begin? We start with a set of assumptions, and then we prepare our three main financial documents based on those assumptions. The first step is to gather some basic market data, which includes simple research and useful information about the product or service. For example, we check what's the selling price of similar products in the market, what's the average cost involved, and what will be the estimated sales volume in the first year. These become our basic assumptions, which actually form the foundation of the entire model, and they reflect our core understanding of the product and the market. Now look at the screen. We'll start with the product assumptions section. Here, we'll list down all the products, mention their average selling price per unit, include the material cost, labor cost, and factory overheads, especially the variable portion of factory overheads. After that, we move on to the sales volume and growth assumptions, where we plot the expected sales and define the expected year-on-year growth percentage. The interesting part is, all these numbers are completely dynamic. You can change them anytime, and the impact will be reflected immediately throughout the model, which allows you to visualize and analyze different scenarios very easily. Along with that, we also add some macroeconomic assumptions, such as the interest rate, expected inflation rate, and effective tax rate. There are also important operating assumptions that include receivable turnover days, inventory turnover days, and payable turnover days. We also consider the depreciation cost and all selling and administrative expenses. We divide the selling and administrative expenses into two categories. One is the variable selling expense, which is usually a percentage of total revenue and changes directly with sales. And the other is the fixed administrative cost. which generally remains the same regardless of sales volume. Next, we look at the capital expenditure, what will be the initial investment, and how we plan asset additions over time. We have to make an asset schedule where we show the initial investment and then year by year reinvestment in capital expenditure. So you can see how assets grow and how much we spend each year. Now, next we move to financing assumptions, both debt financing and equity financing. And at the start, these are all assumptions. You can change quickly to test different scenarios. You can instantly visualize their impact on the business, which is very helpful when you want to see how funding choices affect cash flow and returns. Before we prepare the first income statement, we need to run some schedule calculations, and those schedules must be linked to the income statement, the balance sheet, and the cash flow statement. If you look closely at the layout or structure, you'll find the same format repeats in the income statement and then again in the balance sheet and also in the cash flow statement. So consistency is key here. Look at the screen. Whatever you add in different sheets or calculations, it should follow the same structure and layout. That means we must maintain consistency throughout the workbook. Consistency in formulas is another important rule that we must maintain. So what exactly is consistency in formulas? Look at this. For example, in your first forecasting year, whatever formula you apply there should remain the same across the timeline. You shouldn't change the logic from one column to the next, right? We'll apply the same formula throughout, and it shouldn't be that the formula used in the first column suddenly changes in the next column that breaks the model. So ensure consistency in formulas and also keep consistency in layout and structure. Those are two very important things we'll enforce here. And what are the benefits of doing this? Well, if you have the same layout, structure, and consistent formulas, you can quickly link different sheets together and reuse calculations without redoing work. After that, once we understand the layout and structure, we'll start performing some calculations. First, we'll find out sales units, then calculate revenues, and also look at the price index. So we understand pricing and demand together. Then we'll calculate material cost, labor cost, and factory overheads. And after that, we'll prepare supporting schedules like the PP&E schedule and the equity and debt schedules. These schedules are required so we can quickly link them to the income statement and then form the complete income statement to forecast all the numbers properly. After the income statement comes the balance sheet. We'll discuss its calculations and link the balances to the cash flow statement so the three statements work together. Finally, the balance sheet should show assets and liabilities in balance. That is the first objective of this model, to balance all three financial documents. Now, the most important part of this feasibility model comes in the project evaluation. This is where you check the viability of the business you plan to start. There will be some additional calculations as well. We'll find the unlevered free cash flows and then calculate the simple net present value by comparing it with the discount rate. We'll also discuss the internal rate of return. We'll calculate the terminal value using dynamic forecast years and then recompute the NPV and IRR by adding that terminal value to the overall evaluation. So, the core objective of our feasibility model is straightforward. The project's return should exceed the cost of capital, and only then can the business be considered viable. Finally, we'll convert all these numbers into a dynamic financial dashboard. If you change any variable or input, you'll be able to instantly visualize its impact across the entire model. I hope this model gives you a clear starting point to understand how crucial a feasibility model is for making informed business decisions.